If you love Warren Buffett, and let's face it, who doesn't love Warren Buffett, this ETF is one I think you should watch for current income. I'm talking about ticker OMAH. It's a newer ticker by Vista Shares. And what this is, it's the Vista Shares Target 15 Berkshire Select Income ETF. We're going to get into all the details and more in this video. I will say the distribution rate is a solid 15%. We're going to look at what the fund entails, and then we're going to go into the payments we've seen so far. And at the end, we're going to do a calculation, seeing if it was able to return 15% every single year for whoever knows how long, how much money would that actually make us with the power of compounding. Now, if you are a fan of stocks, of dividends, of growth ETFs, you are in the right place. Don't forget to like the video and to subscribe so you never miss future updates. And again, it's all for free. Let's roll that intro. As with most ETFs, there are some pros and some cons. So we are going to get to all of that and more in this video. But I want to start off by saying a 15% distribution rate is not only achievable, but I feel like it can be achieved consistently. And that's something that a lot of these 20% payers, 25% payers, it worries me a little bit, right? Because we've seen some, like I'll say XPay from Roundhill. Can it really continually give you 20%? It may give you that in dividends, but are we going to see some NAV loss? Are we capped on the upside? Who knows? We need to give each of these some more time, but there are a couple funds that are promising that. Same with SPYT and QQYT from Defiance. I believe that's the ticker. But when it comes to consistent income, my channel is heavily based on that because I like to be a growth and income investor. And I do think investing in Warren Buffett is pretty solid, but there is a caveat to that. So we're going to get to that. Now we can see it's seeking to generate high monthly income. It's investing in a diversified equity portfolio and implementing a data-driven options investment strategy. Nothing really stands out here in that specific section because we've seen this kind of boilerplate language, the data-driven options investment strategy, on a lot of these. And that's not bad. It's fine. It's just how a lot of them, phrase it. Then, of course, we have the core equity exposure. OMAH, that's what I'm going to call it. OMAH provides large and mid-cap equity exposure that can be considered a portion of the core equity allocation in a well-diversified portfolio. And this is what I like. They're already pointing to diversification. We're going to go over the holdings of this fund next, which is very, very important. If you don't know what your covered call ETFs hold, you probably should. And that's why I do like the website. Vista Shares did a phenomenal job with this website. Now, I will say I don't own OMAH yet. I am planning on buying some. I really, really, really am interested in how the performance goes over the next year, really. I want to see if it can keep up. Can it outpace? They have some other ETFs like QUSA that promises the same delivery target, but on different underlyings. So who knows? Then we can see the professional options management. Leverage the years of experience and rigorous research process employed by the team managing Vista Shares options-based income ETFs. If you guys are from my main channel, I did do a video on OMAH a little while ago when they were first talking about it, and we have seen some distributions since then, so I'm excited to discuss that even more. I will say the expense ratio is 0.95%. Up here, it's saying, oh, that's the yield, 0.7%. So it is a bit high. If you're getting a 15% consistently and it knocks it down, the way expense ratios work are a little bit funny. I had a CEO explain it to me, and it makes more sense, but it is a bit high. We may not be paying exactly that, but I do think it is probably in the higher range for what we're looking at. That wasn't a great way of explaining it. If you want to know more, check out my other channel, The CEO with Will Rind. It is going to pay out monthly, which is great, and number of holdings is 68. So it's on the smaller side. A lot of these ETFs track 100 stocks or sometimes even 200 or 300. So we definitely are on the lower end. We can also see it's paying roughly at the end of every single month, which isn't bad in my opinion. I have a lot of bills pull at the beginning of the month. So what's cool is if you were to say retire on this, you would actually be able to get the money right before all your bills come and take all that money from you because bills, they suck. Since inception, we haven't seen a lot moving in the market. It came out in March, which was not a good time, I will say. And so that was a bit of a bummer. I'm sure more so for the team than just for me. But I do think as the rebound is happening in the market, we have a lot of potential with this one. Let's talk about what they're invested in. One, Apple. Of course, Apple is one of the largest stocks on the market. And although it has had a rough go of it these last couple of months, it's down, I think, roughly 20%. I think there is some bounce back potential, and I do think long-term it's a solid buy and hold. Not financial advice. Berkshire Hathaway, American Express, Coca-Cola, Bank of America, Petroleum, Occidental Petroleum, Chevron, Verisign, Moody's Corp, Chubb Ltd. I don't even know what Chubb Ltd is. That's hilarious. I'll have to look that up. What a funny What a funny name for a company. But all in all, most of these are well known, albeit slower growth style of company. And that's how Warren Buffett typically invests. He goes for undervalued assets. And he has all of his calculations that he uses, and well, it's made him billions of dollars. So I'm not going to go against any of that. But what I will say is you don't really want a bunch of flashy stuff when you're writing these covered call ETFs. You can definitely get a 15% return annually because these are lower risk and thus lower implied volatility, meaning the premiums on the options are smaller. And that is okay because we're looking for an income-focused way to make money, and we don't want a bunch of NAV erosion in case things do go wrong and we're getting premiums, but the options are not expiring the way we want them to, and so on and so forth. I'm not perfect with the option stuff. I'm not necessarily an options investor outside of these covered call ETFs, so take everything like that with a grain of salt. Now, exposure-wise, with the sectors, we see financials is huge, 52%. Consumer staples is second with 14%, and then it continues to dwindle down from there. Information tech, 14%. So really, these three categories make up most of it, but financials being the largest. And we see that because we see we see Bank of America, American Express. So it's big on financials. And I'm not a big fan of the credit card industry and what they do, but I do think it is important to target companies that are turning a good profit. And unfortunately with those, it usually means that the American people are suffering for credit card debt and whatnot, but they are making money, and we can utilize that in a portfolio like this. So we're going to jump into the distribution history and see what exactly it's paid out, and hopefully see if it's keeping up with that 15% distribution rate. The first three distributions have already been paid. We had 25 cents, 24 cents, and 24 cents. The current price of the ETF is $19.06. So I went and I did some math. What I did was, I'll explain this. I made an average of the dividends paid out or distributions. It was 24.3333. And then I took that number and I multiplied it to get the number that we're going to get every single year, which is roughly $2.92 per share, which is solid. Divided that by the current price of $19.06, and that gave me 15.32%. Because, of course, I multiplied the 1 by 100 to get the percentage. Now, this is a little bit misleading. It's probably around the 14.5 to 15 mark, simply because the price has fallen 4%. So, some to note, it's not a bad ETF because it's fallen. It just came out at a kind of a rough time, and I am surprised it held up as well as it did. But we go to the dividend scorecard. There's not a whole lot of information out about this, simply because we haven't really seen it trade for that long. And the reason that Seeking Alpha is giving it a sub 4% yield is because we've only had it pay 3 times out of the 12 that it will be paying. So all in all, I'm happy. It's paying out a pretty decent amount. I want that price to remain consistent or even go up a little bit, as it does have some exposure, I believe, to the underlyings, which could really help it in a good bull market. In a bear market, I want it to hold up relatively well, but that's not how these always work when we're in a bear market. I do think we'll be in a bull market for a little bit longer, even if it's a little bit slower, before we have another pullback like we did when OMAH first launched. Again, it launched at a bad time, which is the reason for the return being in the negative. Now, what I really want to look at is, can we retire off of a 15% return? Can we make enough money to live off of? Can we pay for our car payment, our house payment? So let's check in and see exactly what that 15% compounded annually can actually get us. If I were to buy 1,000 shares of OMAH, it would only be $19,060, which is not bad. It really isn't. That's pretty solid for what we're looking at. And in my opinion, this will be an ETF that's around for a while. Now, am I a little bit biased because I really like Vista shares? Maybe, but only time will tell. So I'm going to tell you guys how I have this plugged in. It's paying monthly. Drip is on. We're not contributing anything annually. We're going to start with our 1,000 shares, or roughly $19,000. We're not getting taxed because I invest primarily in a Roth account, and taxes can be different based on your income and how long you hold and all those crazy details. So I'm not including that. Our dividend yield is 15%, and we're not increasing that, and we're not increasing our price appreciation. So it's just going to be a 15% return compounded monthly, not annually, like I did say earlier, over time. So with 1 year, we can see we're already starting off really strong. In your first year, you're going to get $2,860 in dividends. That's a really great start. And at the ending balance, you're getting almost $22,000. So it's really going to pick up fast. But can we live off of this? Can we eventually live off a $19,000 investment? I don't know. After 5 years, it's already up to $38,000. We've been paid $19,000 in dividends, and now our annual dividend income moving forward is going to be that just sub $6,000. So definitely not enough to live off of, not even enough to really cover a car payment. I guess maybe if you had a cheaper car payment, but no, that could, you could, $6,000, depends, really depends. So 10 years. After 10 years, your $19,000 is now worth $77,000. You've received $58,000 in distributions, and we're making $11,500 per year. This is where the compounding is really going to start to pick up. Yeah, after 20 years, and that was a big jump. $77,000, now up to $312,000. You could sell out after 20 years and buy a house. You could continue investing and keep making $47,000 a year. We can also see we've made $293,000 in dividends over this time period, which is amazing. Now, again, all of that is going back into the ETF so we can buy more and more, but that is why compounding is so amazing. And although I wouldn't recommend trying to live off of $47,000 a year, there's a lot of people in the US and worldwide, specifically worldwide, that do it, a lot of them, and even significantly lower than $47,000. In the US, that's still pretty low, but people are doing it, which is a bummer. Now we can see 30 years invested. What is our $19,000 going to turn into? $1.26 million. And here's where it gets insane. One investment potentially, and of course the market's going to go up, it's going to go down. We'll have good years, we'll have bad years. But all in all, $1.2 million paid in dividends over 30 years. And our annual dividend income is $189,000 moving forward. That is tough to beat. And I will say, if you can't live off of that, that's tough. I think in 30 years, this may be closer to the lower range. I'll be honest, with inflation, who knows where we're actually going to be, if this will be anywhere near enough to live off of, but it is cool just playing pretend. And I will say, if we jump another 5 years into this, say you are 25 and you want to retire at, 65? Let's add another 5 years. If we go from 30 to 35, we can see what's the difference from 1.2 million all the way to $2.54 million. That means we've made $2.5 million in dividends, and annually we're going to continue to make $381,000. If you can't live off just under $400K in 30 years, the U.S. is in trouble, right? The U.S. is in big trouble. We should be able to live off of that. It should be a very not super lavish, I'd imagine, but we never know with inflation. But I do hope you guys found this video enjoyable. If you did, chances are you're going to like these popping up on your screen right now, including one on SCHD, the growth dividend ETF that has been phenomenal, and of course, ticker QQQI, the award-winning ETF. Don't forget to like and subscribe so you never miss an update, and I hope to see you in the next video.